When we look at the high yield market currently and think about it from where we're seeing the best opportunity and the most mispricing, often we think of that as in the more stressed parts of the market or the higher levered part of the market. But right now, actually what we're seeing is that when we take away the distressed part of the market's trading at all-time tights. And really the opportunities in our mind right now, or things that we're getting really excited about, is in that higher quality segment. And that's largely because investors are really bidding up the prices of that quality of the market, double Bs in particular. And we think that there's a great opportunity to really overweight the credits that we think will outperform throughout the cycle. So when the cycle does turn, we believe that there's going to be a lot of opportunity there.
I would say that the market is probably underappreciating the risks in the credit market and maybe mispricing credit to a small degree. I would say that levels are a little bit inside of fair value. We're firm believers in during a cycle that prices reflect fundamentals over time, but there are many periods in a credit cycle where technicals really push pricing away from fundamental fair value, and I think this is one of those times. If you think about the change in interest rates over the past 2 years, it's been fairly dramatic. So there's been this big grab for yield, this technical grab for yield in portfolios, and I think investors may be ignoring some of the fundamental risks that are at play. Some of the models that we utilize to help us determine fair value are actually showing that the risk premiums in the market are quite skinny right now. And again, we think it's due to the technical push and also the fact that the economy's really been buoyed by all of the fiscal plans and stimulus that have been put in since the pandemic. So you have all of that going on the technical side. On the other side of the equation, small and medium-sized businesses in particular are grappling with a higher cost of capital. We're seeing that play out in equity markets. The Russell 2000 not performing at all like the S&P 500, but the S&P 500, as everybody knows, it's always talked about, is buoyed by 5 or 6 big tech stocks. So there's a really bifurcated market there, and we're just concerned that as the economic data has been coming in a little bit weaker, that credit might be mispriced a bit.
Now, if you look what's going on in the geopolitical sphere across the entire world, basically, there's a lot of risk. Here in Europe, you see, for example, the French elections, which led to some sort of volatility, but also still very limited. Also, the macroeconomic outlook in both Europe and the US is still very much uncertain. And also the central bank policy, also both in the US and Europe, is creating uncertainty for the market. Now, in our opinion, what you see is that the spread difference between higher quality, so single A paper, and triple B paper has compressed a lot, and you're not being compensated for taking risks lower down the credit rating spectrum. So if you ask me, I would be trading up in quality because you give up limited amount of spread, but you invest actually in higher quality companies, which this point in the cycle makes a lot of sense if you ask me.
So we had a lot of elections this year. We started right out of the gate in January with Taiwan, and then we moved, I believe, into Indonesia. Probably the most recent elections. So we're talking India, Mexico, and South Africa. Probably led to the most concern. And so we saw a lot of volatility. I think what we're seeing now is that instead of going back to the old playbook and assuming that the worst will happen when you see this kind of unexpected result, we're seeing the institutions really sort of handle what the change might be. And so it could be how the coalitions are formed. It could be how the ministers are appointed, their credibility in the marketplace. So I think that maybe this idea that the knee-jerk volatility that we saw really in the sovereign spreads and also in the currencies was maybe a little bit of an overreaction. Of course, there's going to be bumps in the road. We have to see how a few outstanding issues play out. But I do think, in general, we have seen the results of these elections handled within their own political constructs.
I think one thing the market could be underappreciating at this point is just how long we could trade in this lower spread market. As recently as 2021, for example, we did trade almost a full calendar year sub 100 in IG market spreads. And really, so far, we've just seen about a half year period here year to date in 2024. On top of that, we see a continued normalization of corporate credit fundamentals with many credit metrics deteriorating slightly to where they were or slightly worse to the pre-2020 time period. So the logical question would be then, given these facts, why might we expect credit spreads to continue in this lower end of the range or continue with less credit spread volatility here in the nearer term in the future? And I think the simple answer to that would be all-in yields. So yield-based investors look at this market here today a little bit differently. Higher all-in corporate yields, of course, have many potential benefits. More liability-focused investors can use them to de-risk, and more total return-seeking investors can use them to lock in rates or yields that they haven't seen in quite some time. So this period, we think, is unlike many other periods we've seen over the past 10 years, where we have had much lower corporate spreads, just given the fact that all-in yields are much higher than they have been over the same time period.